Now, financial markets are quite efficient. Okay, and the reason why we say they're efficient is because anytime there is an arbitrage opportunity, anytime there's an opportunity to make profit from financial markets, okay, it's easily um, taken advantage of right away. Okay, when this happens, okay, the equilibrium price goes back, the price goes back to what it was before, it goes back to your equilibrium price. Okay, so say for example, you have the price of a security, okay, you have price of a security, okay, is lower, let's say, than a similar security in the market. When I say similar security, we're talking about rate of return, we're talking about return on investment, so on and so forth. Okay, so if the price is low, obviously people will buy more of the security. Okay, and eventually they'll get to a point where the price of the security will reach equilibrium price, where demand equals supply. Okay, we know from economics that as the price goes down, demand goes up. Okay, let's assume that this is your price. This is your price over here, excuse me, and this is your demand. Okay, as price goes down, demand goes up. And we know that when it comes to supply, as price goes up, so does supply. Okay, so basically, we're saying that price is inversely proportional to demand and directly proportional to supply. So when it comes to the price of a security, when it goes down, okay, when the price of a stock, which is similar to another stock, it goes down. Let's say in the same industry, let's say we're talking about energy over here, utilities, or so on and so forth. Let's say it's the same industry. Let's say we're talking about Canada Savings Bond. Okay, let's say we're talking about Treasury bonds. Okay, so if the price of a security goes down, okay, and the price of another security, which is similar to the one where the price goes down, it stays at, let's say, $10 a share, okay, then obviously people will try to take advantage of the price difference. And when they do try to take advantage of the price difference, what's going to end up happening is, okay, they will end up buying the security to an extent where the price will return back to its equilibrium price. So if the equilibrium price was $5 a share, it will go back to this equilibrium price. Okay, let's say the price per share was $5. It went up to $10. Okay, so let's say one security is worth $5 a share, another security is worth $10 a share, and these are similar securities. Okay, they will buy this one because obviously as the price is low, the demand is high. They will buy this one to an extent where this price will return to this price over here. Let's assume that this is your market price. Okay, so this has to do with arbitrage opportunity. You're trying to take advantage of price differences in the market, okay, of similar products and services. All right, this could apply to, um, let's say, franchises, okay, where you have a burger franchise. Okay, one franchise might be selling burgers in one country for, let's say, $10. Another franchise could be selling the same burger in another country for $5. Okay, so this is an example where people might try to take advantage of well, arbitrage opportunity, profit opportunity. Okay, difference in prices. However, okay, there are other factors that kick in when it comes to arbitrage. Okay, these factors include, but not limited to, transaction costs. Okay, so obviously you're not going to travel to another country just to enjoy a burger that's $5 less. Okay, why? Because the transportation cost to go to that country is much higher. Okay, so this has to do with transaction costs. All right, so this is for price of goods and services. Now, to understand how this works, okay, we can put this into a formula, and this is your rate of return formula. So this is R equals your coupon price, which we'll factor out because we're not considering coupons here. Okay, plus PT1, which is your future price or the increase or reduction in price. Take away your original price or price now, all divided by price now. Okay, PT0. So if you factor coupons out of the equation, we now have a different equation that looks something like this. Rate of return equals price. Okay, PT1 minus PT0, the original price or price now, all divided by price now. Okay, so now if you try to figure out, okay, your rate of return will be inversely proportional to price now, or the original price, and it will be directly proportional to your future price. Okay, anytime you have an increase or reduction in price, this will be your PT1, okay, and this will be directly proportional to your rate of return. Okay, so the price will go up in value. Okay, price will go up if the rate of return goes up. Okay, price will go down if the rate of return goes down. That makes complete sense, right? So the idea is, if the price of a security, for example, or a stock, okay, let's say the price of a stock goes up, what's going to happen is your PT1, okay, will go up. So let's say this is $10 per share. Take away the original price was $5 a share. Okay, all divided by PT0, which is your original price. So this will be $5 a share. So now you have 5 divided by 5. Your rate of return, let's say this is 1%. Okay, let's assume that this is 1%. Okay, which will be equal to 0.01. All right, now the idea is, okay, if PT1 of a similar share or security, let's say this is in the same industry, let's say we're talking about utilities, let's say we're talking about energy, let's say we're talking about crude oil, okay, or home insulation, or anything else for that matter. Okay, if it's in the same industry with the same kind of risk, let's say this is moderate, okay, the risk level is moderate on your fund facts. Okay, what's going to end up happening is, okay, people will buy this security, okay, until PT1 equals PT0. Okay, why? Because the rate of return is much higher, right? PT1, if PT1 goes up high, if the price goes up high for a certain share, your rate of return will go up as well. And because the rate of return goes up, people will start buying this share because obviously there's more profit in buying this share. And as soon as they start buying this share, they keep buying this share until the rate of return for both these stocks is the same for both types of shares. Okay, so you have similar shares. Okay, let's say we're talking about gold, for example, or let's say we're talking about precious metals, or let's say we're talking about crude oil. Okay, so crude oil. Okay, and let's say this is crude oil coming from one part of the world, and then you have crude oil coming from another part of the world. Okay, similar shares. Okay, eventually what's going to end up happening is people will buy, okay, shares that are less expensive to buy. Okay, as the demand goes up high, which means that eventually the price of these shares, which is PT1, will return back to its equilibrium price, PT0, the original price. Okay, so that will be it for this video. On behalf of V Electronics, this is Ubaid. Have yourself a